for the majority of 2024, it has been dominated by technology and these magnificent seven names. When it comes to technology or growth, these stocks have been making up the majority of the return that investors are seeing. In fact, if you look at this chart and you take those magnificent seven, which is Microsoft, Apple, Alphabet, Amazon, NVIDIA, Meta, and Tesla, they're outperforming just over the past year the S&P 500 without them in it by over 40%. This is just simply unsustainable. These stocks have rallied on the fact that artificial intelligence is a big deal, and it is going to change the way we do a lot of things. This has also been driven by the fact that it's been widely thought of that the Fed was going to come in and aggressively cut interest rates throughout this year. And lastly, some of the data that we got in the first half of the year showed this soft landing. So these justified, to some investors, these elevated valuations. But to us, when you're looking at valuations in some of these tech names and sectors, as high as they've been in since the dot-com bubble, but you're putting that in a scenario where the economy is actually not as great as some had anticipated, and that the Fed's going to not have as much flexibility. That doesn't help those valuations, and that actually is a headwind for those valuations. Now, most recently, we've seen these correct. We have seen some of these names down pretty substantially. We've seen the NASDAQ lag behind some of its other U.S. counterparts, but we just still think at this time, we're not that far off of some of these highs in this technology and these growth type of sectors to feel comfortable to put money to work there. Instead, what we're doing with our global equity exposure is we're staying relatively neutral. We're holding a lot of cash because the volatility we've seen in the couple of days, while it seems pretty violent on paper, we're really still sitting near some of those record highs. We haven't fallen more than 10% in the majority of the different indices, and we also are definitely not in a bear market. So we're still wanting to have cash to put to work and find better areas of the market to do that. Now, what are we looking at? We're looking at some of the areas that have been beaten down, and we've seen that most recently here internationally. We've seen small and mid-cap stocks erase all of the gains that they've seen as of late. These are some of the areas that are starting to look interesting to us to put cash to work because they're pricing in more of the downside risk than we think in some of its large cap counterparts. But the most important thing as we go forward into the second half of this year, the economy is slowing. It's slowing pretty rapidly. The Fed is likely going to cut interest rates in September, but we're not in the camp that there can be an emergency Fed rate cut. And we're also not in the camp that we're going to see 150 to 200 basis points of rate cuts this year. So we think that going forward, it's okay to tread lightly, take opportunities like we've seen in the past couple of days, look for areas that might be cheap, but there's going to most likely be more opportunities the rest of this year. August, September, October tend to be very seasonally weak periods for equities. And don't forget, we have a presidential election and a lot of uncertainty after that going into 2025 from an economic standpoint that we think that we'll probably have plenty more opportunities to put some of this cash to work. Be patient. Do your due diligence. We're doing that for our clients. We're doing that with all of the investments we have specifically in the global equity markets.